Good morning, everybody, and welcome to this B2 training, Access to Finance, organized by the ROSEWOOD 4.0 project. My name is Javier Casado, and I'm working as a project manager in Steinbeis-Europa-Zentrum. I don't know where I can, which is the coordinator of this Horizon 2020 project. Before starting with the B2B training, giving the floor to my colleague Samantha Michaud, I would like to show you some general information regarding ROSEWOOD 4.0. As many of you know, wood can have an essential role in a new circular bioeconomy, innovation regarding digital solution, and also knowledge transfer in wood value chain can increase the competitiveness of the forestry industry and also to support the development in rural areas in Europe. ROSEWOOD 4.0 is a continuation of the ROSEWOOD project, and it's built on the ROSEWOOD network of 4 different regional hubs, but increasing with a 5th hub additionally in the East Europe. The project focuses on digitalization for a sustainable wood mobilization in Europe through knowledge transfer, training, and coaching. The project has already identified best practice, digital solution, and digital innovation, addressing an identified gap in the forestry sector. This is the lack of modern ICT solution and resources. Which are the objectives and activities in the project? We have like 3 different pillars: information and knowledge transfer. This was done through different compilation of abstract, fact sheet, and videos from the best practice and digital solution identifies. The project had already developed 3 different MOOCs with different webinars and podcasts, and also prepared a big database in knowledge platform, sharing all the best practices and digital solutions collected by the consortium. We are around 350 best practices. Cooperation and innovation between all actors within the wood value chain. The project, for example, has prepared 5 different regional roadmaps, identifying the current situation in the wood sector and forestry sector in the 5 different regions in Europe, and also including the SWOT analysis for this region. And we also prepared one cross-regional roadmap at European level. The third pillar is the business support. We are going to design new business opportunities through different creativity workshop, trying to get new business ideas, with organization also of B2B workshop and training like today, and developing some additional training material. Regional hubs and partners. Here you can see the map, the distribution of these 5 regional wood mobilization hubs: Northern Europe, Central East Europe, Central West Europe, Southern West Europe, and Southern East Europe. This hub, we're working, selecting and collecting these best practices at a regional scale, but then we have the chain of this best practice and information between all the hubs at the European level. Here you can have an overview from the consortium. As you can see, in the 5 hubs, we have between 3 or 4 partners. In total, the consortium has 21 partners. And as I said at the beginning, Steinbeis-Europa-Zentrum is the coordinator of the project. Where to find the main result and finding from the project? With this slide, I would like to invite you to visit the ROSEWOOD 4.0 website. There you will find general information about the project, the consortium, partner, and also the latest news. We have also a collection of video based on selected best practices, where you can find here in the website, but also we have a dedicated YouTube channel. And up to now, I think we have around 16 different videos. At the end of the project, we will have more than 25. Then we have the resource section. This is a very important section, including the knowledge platform. This is a best practice database or repository containing more than 350 best practices and innovation. You can see here, we have a search functionality, so you can share, for example, using different the language or the type of innovation, the country, the domain. So you will have a kind of different option and clicking in the different options, you will have the first sheet that this will be a kind of summary of the main information regarding to this best practice, but also link to website, to additional document or the contact information, for example, for the owner of this, this solution. In this resources section, we have also the five regional roadmap and also the cross-regional roadmap available for all the stakeholders. The project had already prepared 3 massive open online courses with different kind of learning format, webinar, podcast, video lecture, etc. Here you can have a look. It will be available pretty soon, and we have 3 different topics. This is the first one, digital support for efficient harvesting operation. The second one is digital tool for climate adaptive reforestation, and the third one is managing hardwood perspective for new forest owner. And in my last slide, I would like to show you the different social media that we are using in the project, and you can follow the last information and news. So this is linking in Twitter and also in the YouTube channel. Thank you very much for your attention. And now I would like to give the floor to my colleague, Samantha Michaud.
Now I hope everything is going to fine. So I would like just to start this this training with some icebreakers. So I'm going to start the poll now, and I will ask you to take a moment to answer the 3 questions. So just to start, what's the strangest thing you did while attending an online meeting? And then if you scroll down, you can see, I would like to see if someone has already experience with fundraising campaigns and who is already familiar with the concept of investment readiness. Okay, so everyone eat breakfast. Okay, nobody was experienced or did experience a fundraising campaign, and nobody is familiar with the concept of investment readiness. Right. Okay, so let's go now into the presentation. Okay. Right. So first, I will start with presenting you the key factors for investment decision. Then we will go through the typical venture life cycle before presenting you the different sources of finance. Then I will show you which type of financing suits to the companies in keeping of their development stage. I will also list or present you a list of questions that you should ask yourself before steering an investment decision. Then I will present you a methodological framework for analyzing your investment decision. So is it worthwhile to go for an investment? And then we will go through the 5 steps to become investor ready. I will provide you also some don'ts that you should avoid when you are preparing a pitch deck. I will present you what are the key slides that any pitch deck should contain. And last but not least, what you should do and don't do when you are dealing with investors. So it's quite a comprehensive program. It's going to be a long session, but I will try to make it as much comfortable for you as possible. And at the middle of the training, I foresee a coffee break of 10 minutes just to let your brain getting a rest a little bit and treating all the information that you will get today. So So regarding the key factors for investment decision, the first, it's very important to define which stage your business reached. Yeah, did you recently establish your company or not yet, or you are an established company? Because of course the source of financing is depending on that point. Which level of risk? So how risky is actually your business idea? Yeah. If the risk is very high, of course, investors will request more remuneration through a higher interest rate or through the exit strategy. So the risk is it's a key factor when it comes to investment. Are your goals simply achievable? So it's very important that you make the investor, that you make yourself, but also the investor clear that you are able to achieve your goals, that they are realistic. You need to have a clear expectation when it comes to money. So you have to have a clear number in your mind when you start thinking about an investment. Yeah. And thinking which kind of how much money first you need, and also to understand what the investors are really expecting from you. Yeah. So if you are applying for debt, you have to consider that the investor will seek for an interest rate that could be quite high in keeping of the level of risk. And this can have some effects on your valuation at a later stage. The time to ask for investment, this is also very important. You should not be it should not be too early or too late. Yeah. How much finance you request. So it's important that you exactly know how much you need and for what you need it. And last but not least, the point on valuation, which is a very complex dimension when it comes to investment decision. We will go through it at a superficial level because it's actually about valuation. We could make our own training on that. So it's quite a complex point, and it's also a critical point when it comes to negotiation. Because if you evaluate your business too low, the investors might request a significant amount of shares or even reject your debt. Yeah. And if your valuation is too high, it's possible that the deal will not be concluded because other deals are more attractive. You should keep in mind that one investor gets 100 business plan or pitch decks a day. Yeah. So the competition is quite high, and that's why it's very important that all those key factors are you are well prepared and they are clear in your mind before starting. Just for you to show what are the typical venture life cycle when it comes to financing. So when a company starts, so there is at the beginning first a research phase where it is about to settle your intellectual property rights strategy, how you are going to manage your assets, how you are going to exploit your assets, etc. Then start an early stage phase where you actually develop your product, make it market ready. And this is the time also where most ventures are facing so-called valley of death, which is a typical liquidity problem. So they are actually running out of money to keep financing their development, and it's a phase where normally they are seeking very actively for funding to be able to further develop the product and bring it to the market. When the product enter the market, the company in general enter a new phase, which is called this expansion phase. So they have to basically establish their position on the market, and there they need other source of funding and also dealing with other type of investors. So as you can see in the early stage phase, it's you will be more seeking money from family and friends, from business angels, or from the crowd, but also venture capital. For example, in the last years, there is a new community of early stage venture capitalists, which has been created in Europe, particularly when it comes to deep technologies, which are technologies coming from the research and which needs long development phase and also high capital. But in general, normally venture capitalists, they are more fitting to the expansion phase because they are actually only seeking for return on investment. And it could be that in the early stage phase, you are not generating already some incomes for your product since it's not on the market yet. But we will go through all those type of investors and phase in the next slides. I would like to present you the different source of finance. Well, there are three main pillars. The one are the debt financing. So it's about basically borrowing money for working capital or capital expenditures. So you take up a loan against an interest on the debt. There is the equity investment. This is where basically you raise capital for business purposes through the sale of your ownership rights. So you are actually selling shares for the capital that you get. And the third pillar is all about public financing, so about grants and subsidies that could be coming from the European Commission, from a national funding program, or also regional funds. I will go through each of those financing source for the three pillars. So in the debt financing, under debt financing, so they are the typical loans lent by banks. You can also lend some money from your friends or family. In general, you pay your friends or family with equity shares, but it happens also sometimes that they lend you the money with interest. You can also afford for microloans, so so-called invoice trade financing. So this is, for example, a financial solution which is offered to very small business to borrow funds against the amount pending from their customers. So, for example, you have sold a service or a product to the customer, and he has a payment time, and in order not to run off liquidity, you could ask for microloans just for the amount that the customer is going to pay you. So it's a form. This is more when you are an established business that it's interesting. Startups are not doing this type of financing. Then you have the leasing. So this is also a form that you can go for it if you want to not to spend too much money, you know, to pay an equipment, etc. There is also the part of crowd lending. The crowd lending is basically it's a form of crowdfunding, but it's about a group of small investors who are lending a small amount to companies to help them to develop their business. And then the typical bonds, this type of debt financing is actually more for established businesses. So it's when, for example, the issuer owes the holders a debt and is obliged to pay them interest or to repay the principal at a later date. They have to pay the interest at fixed intervals. In the part of equity, there are different instruments as well. So as I already said, there is also the venture capital. I put in brackets here the EIC, the blended finance, because this is actually a EU. It's a mixed financing, which is composing. So a mixed financing from the European Commission. The EIC is the European Innovation Council, and they provide grants, but also equity investment. So, but it's a form of venture capital, and that's why I put it there, because it's the equity investment, although it's also part of a grant program. Then you have the business angels. Then the crowd investing is usually it's through crowdfunding platform. So you get small amounts from money from a big group of investors, small investors, who gets then equity shares from your company when the business is running. There is also strategic investors like corporates. For example, there are many big players or big companies have their own corporate venturing department. So they are investing money in startups, in small companies, in general, companies who are developing products that are interesting for their own portfolio. The advantage for the startup is that since those big players are active in the field where the startup is acting, they can open up a lot of distribution and commercial channels and also put their network available, which is very interesting for the companies, for the small companies. Friends and family, like I said already, and of course they can bring also their own resources. Each founder can bring his own money. And then we have the grants, like I said, 3-level, EU, national, and regional. So in keeping of the development stage of your business, they are a dedicated type of financing. So as you can see, there are 4 main stages in the development process of a company. So the first stage, that's what I said at the beginning, you are in this phase, you know, still in the R&D phase, developing your ID. So we call it the inception phase. In general, you have here the possibility. So most of the founders, they start with own money, and they ask family and friends. And in some case, they can already seek for a business angel or a crowdfunding platform, but as a peer-to-peer lending, which is actually what I said before, this crowding investing, where a group of small investors through a platform is lending you money. So as you can see, the first 2 phases, those are the early stage where you have this early growth. So you can there seek for business angels or crowdfunding, but also you can go to the bank. and ask for a loan. When you are expanding, so this is more the next phase, when you are when you are reaching the mid-cap stage, this is more where you work with private equity funds or venture capital funds. Although some business angels are still also supporting some companies in this stage. And the last stage is when you go public. So you are, well, it's one of the, it's where you go, you do your exit, basically. For example, if you want to go public, you have to publish a so-called IPO, which is basically an initial public offering when the shares of the company are sold to institutional investors and usually also retail investors. So it's basically when you go, when you get public and you get to the stock exchange. So which question should you ask yourself, or for the people who are supporting companies? I'm thinking of the hub managers here in the training, or also any kind of business organization who are working with startups, who are supporting them. There are a row of questions that has to be clarified and answered with the company. So first, a set of background information that are very important to start the process. So what is the current level of turnover and employment of the company? Yeah. So how much money did they already raise, or basically did they already generate, and how many people are working for the company? This is very important to establish how big the company is. If you are a very small or medium-sized, or already a large company. In which type of industry or sector does the company operate? This is also very important because a number of criteria are depending on it. For example, the level of risk. If you are active in the field of health, you have very long development phase. I mean, you know that also when, for example, if you are in the pharma industry, you need to go through different clinical studies. I think it's 4 phase, and this is very capital intensive and takes a lot of resources. So this will of course play a very big role, of course, in your investment decision. What is the ownership structure of the company? Yeah. So is it a capital company? Is it well, I don't know. It's the company status are different from country to country, but it's of course very important because this play a role also on the tax level, but also for the investors. What is the nature of the company operation? So is the company exporting or importing? Is active at local, international, or global level? What type of innovation does the company bring in the mix, and how is this innovation measured? So how much ahead of the competition does the innovation bring the company? What is the technological state of the art in the company's industry sectors? So all the aspects, the patents, the trademarks, the copyrights, etc. This is very important because it's of a very valuable asset, which is also playing a big role in your valuation. Yeah. If you are owning the patents, of course, it increases the valuation of your company, and it makes so you increase also the credibility, your financial credibility towards investors, because they see, okay, there is an innovation which is worthwhile, which is protected, which is hard to reproduce, and which has also a potential at the technological level. Related to the investment profile, you have to ask you, okay, What is the amount of money needed? How far will this finance take the company? Yeah, so make a financing timeline. If you ask for 1 million euros, how long are you going to hold with 1 million? Yeah, which milestones are you going to reach with the 1 million? So it's very important that you set up a financing timeline, yeah, with clear milestones and clear tickets, financing tickets. So how much money you need to reach each milestone. What will the company use the finance for? Yeah, this is very, very important. It has to be clear for what you need the money. You need it for research, for development. You want to do a market analysis. Is it for marketing? Do you want to expand to new markets, or you want to diversify your business in creating new products? Is it to get new working capital, etc., etc.? Do you need the money for an immediate cash flow, or it's more to anticipate future projects? Because of course this will also depend. Regarding the suitability, what are the company's financial and business development projections for the next 3 to 5 years? Any investor needs to know from you that, or to see that you know where you are going, that your vision and your mission are clear. Yeah, and in general, companies should deliver a scenario up to 5 years with a clear financial and business development projection. What percentage the amount required will be made available by the company owners? Yeah, so how many shares are you going to give for the money you get? Yeah, this is also very important. This plays also a big role when it comes to valuation, because if you ask, for example, 1 million euros and you give for the 1 million euros, you give 20%, it means that you valuate your company 20 million. Yeah. So this is also very important that you are aware of how much shares, how much percentage you are able to give for the money. What type of collateral the SME could be providing, also to secure the financing request? It's just to show also that the company is not relying exclusively on this investment, that you have also other source of financing or other assets that you can guarantee. You provide some guarantee also for the investment. So like I said, for example, the IP, or if you have any kind of real estate collateral, buildings, etc. So this is about providing some guarantees. Is it the first time that you are requesting financing? And if not, which type of financing did you receive in the past? So investors want always to know what is your financing history. Yeah. If you get already grants, if you got already business angel or seed financing with business angel, etc., etc. There are 3 important elements of an enterprise when it comes to decide which kind of financing suits to your business. So you are assessing three factors. The first is your level of innovation. So how innovative is your business, or is your business ID? Yeah, because this is directly related to the level of risk. Yeah. Although it's not because a company is not very innovative that the risk, so a company can be quite less innovative but still have a very risky business. Yeah. So it's not automatically relying to each other, but it has an influence. So the size of your enterprise, yeah, if you are a large company, normally they are able, for example, to provide some bonds. So that means that they are lending money and providing for this money they lend some shares. Yeah, this is something that only large companies can do because they have already enough shares that are able to be converted into capital. And of course, how much money? So how big is the amount of money? Do you need a small financing? Do you need a large financing? So three dimension will always be in consideration when you are when you have to decide yourself about the type of investment you should go for. I will present you. So this is a methodological approach which has been developed by the working group of the Enterprise Europe Network, Access to Finance, which I found very simple to understand which type of financing is suiting for each kind of company. So as you can see, I said 3 levels of decision. So how risky and how innovative your company is. So if your level of risk and innovation is low, and for example, you are a micro company, yeah, requesting a small amount of money, you will go for family and friends, microloans, leasing and crowd lending, and any kind of public funding, so grants or subsidies. Grants and subsidies, as you can see in this table, are actually open to any kind of companies, big, small, micro, highly risky, highly innovative, etc. It plays more a role at the level of the private financing. So if you are a company, for example, you are an SME, highly innovative, highly risky, and you are looking for a large amount of money, then in that case, for example, you can see microloans are interesting, leasing, venture capital. You can do an IPO in that case, so go public, and or work with a strategic investor, so with the corporate venturing. For a small company, like for example, startups, so startups can be micro companies or small companies, in keeping of the level of money you are seeking, you will go for either friends and family, microloans, leasing, crowd lending, but also venture capital if you need a big amount of money, because venture capital, for example, I know very few venture capitalists who provide actually less than 500,000. So it's starting from 500,000. So we are talking actually here about big amounts of money. So yeah, I will not go through each of them. But I will ask you to try now a small exercise. So I'm going to prepare a poll with some question. And so I will go back. I will put the slides back because you will need it to answer the poll. So it's about, I will ask you to try to define which financing form you would need if you are an SME, so you have between 20 and 50 employees with a high level of innovation and risk and a large amount of money. Which form of financing would you seek for? The second case is you are a small enterprise, so you have 10 to 20 employees with a low level of innovation and risk, and you need a large amount of money. So which form of financing would you seek for? And the last question is, if in the case you would be a micro enterprise with a high level of innovation and risk and a small amount of money. So I let you 3 minutes to go through the question. Don't hesitate to use the table, the decision tree, and we'll see if which results are coming up. I don't, things are moving now, okay. Okay, so people are quite actually, no, things are still. So the 3 minutes are over. I hope everyone had the possibility to answer all the 3 questions. So I'm going to close the result and present. So let's go. Okay. So you are an SME, 20 to 50, high level of innovation and risk, and a large amount of money. So an SME, you are in the category medium sized, so under M, yeah? Looking for a large amount of money. So we have, so yeah, microloans, leasing, EU grants, correct. Venture capital. Business angels, no, not really. When you are seeking for, like I said, business angels, they provide smaller amounts of money. There are some business angels providing up to 1 million euros in funding, but they are a very special community. We call them the archangels, but in general, a business angel don't provide more than 250,000, and 250,000 sounds a lot of money, but actually for a company, it's a small amount. So business angel will not really be the right investor for SME seeking for a large amount of money. Okay, for small enterprise, so a startup, for example, from 10 to 20 employee, a low level of risk, yeah. So we are in the small category, low level of risk, and seeking for a large amount of money. So there we have actually, they don't have so much possibility. They can only go to a strategic investor. And I have to apologize because the right answer is not in the selection. But you're right, EU grants they are affordable for EU grants. Yeah. So for a micro enterprise, the most possibility, so seeking for a small amount of money and a high level of investment, of innovation and risk, they're correct. Family and friends, yeah. Microloans, correct. Okay, very good. So most of you have well understood actually everything what I have told until now. Is there any question in the meantime? Okay. So let's go to the concept of investment readiness now. So investment readiness it's quite a wide concept, which includes the different steps to be taken to align the company business with the financing provider's objectives. So it is about making your business ready to meet investors. The 5 steps to investor readiness. So first, define your strategy. What is your market position and how can you protect it? How are you going to enter your target markets? Can you explain how your product will evolve? What does your product roadmap look like? What about your past traction? How can you show that there is demand for your product? And what is your exit strategy? And how aligned is your founder team? Does everyone have the same goal? And so we will go through all those aspects now, and I will provide you some tips how you can, what you have to consider and plan and define when you are defining your strategy. So when it comes to your market position and how you can protect it. So as I said at the beginning, it's very important that you assess your level of development, the so-called technology readiness level, which is the level of development of your innovation, but also assess the market readiness of your innovation. How far is your innovation from the market entry? Yeah, how ready is your innovation for the market? And of course, to be able to strengthen your market position and protect it, you have to develop a very strong unique selling proposition. So let's go through the TRL scale. So I suppose you are all familiar with this scale because actually it's the reference when it comes to funding, particularly public funding. So as you can see, it's from 1 to 9. 1 starting with your basic research, so the first idea, then you develop a concept, so then you get an experimental proof of concept, so this is TRL 3. Then you go further by developing a lab prototype, so a first experimental prototype, so this is the TRL 4. But then you have to guarantee that this prototype is working also at the bigger level. In a relevant environment. So you will go through a demonstration phase. So this is TRLs 5 to 6 to prepare your small scale production and in order also to reach a TRL 8, which is the phase where your system is complete and qualified. And this is actually the last step before getting to the market. So when you reach TRL 9, means that your product is on the market. As I said, it's also very important to assess the market readiness of your innovation. Yeah, when you are, so we call it the MRL level. So basically it's, for example, so you have here, the first is stage at the basic research. Yeah, so you have no evidence at the moment, so you need to collect some evidence also from potential clients, also to see if there is a market potential for your ID. Yeah, so this is the typical phase of ideation. Then you have to test your business. So this is the TRL 4 to 5, where you start involving stakeholders or so-called early adopters. Yeah, so it's basically to test your process. Or the process, so how you test the match of your product with the client needs. Yeah, so this is also where you start with the phase also where you strengthen your value proposition also. And then the next phase, so it's generating traction. So you start to work actively with potential customers. So you generate market traction. Yeah, this is the part, the level 6 and 7. And then when you go through the traction, so you have generated some traction, you start scaling up your innovation. And this is the part basically where you prove the scalability of your product, that your product is fitting to a dedicated market, but also your business model. When it comes to creating your USP, so what is a USP? It's a unique selling proposition. So it's about actually making your product more interesting and different, more valuable towards the competing solution. So you start with a competitive analysis, yeah, to assess the strengths and weaknesses of the competition, yeah. So see, okay, how weak are my competitors? So if they are weak on this aspect, this is a gap that I can fill with my innovation, yeah. So it's about convincing that your product offers a unique benefit to your customers, and that's why you need to analyze the weaknesses of the other products to be able to show, okay, the other products they are weak on this aspect, but my product is strong on that. Yeah, benefit can be shown through a quality improvement. You provide a product at a lower price, or you increase the efficiency through technological advances. This can be different. Yeah. So the main questions at this stage when you are developing your unique selling proposition is, who are my major competitors? Which or what competitive products or substitutes exist? Yeah. What are the future expectations regarding the market success of these products? It's very important to also watch the market trends. Yeah, where is the market going? What strengths and weaknesses do the competitors have? What weaknesses does the innovator company have in relation to his major competitor? What advantages does the proposed product offer compared with existing products? Yeah, so you can consider this list of questions like a checklist. Yeah, so this is what you should go through when you are developing your USP. So now again, a small exercise to check your understanding. I would like to ask you to evaluate the TRL and the MRL in different scenarios. So I let you 3 minutes to answer the questions. And to help you, I will put the TRL slides. The two first questions are on MRL. So I put the MRL slides here to help you to have a better overview of it. Okay, I put the TRL slides now. Oh, sorry. Yeah, for you to answer the next question. Oh, I just see that they are twice the same question. I'm sorry for that. So do you need some times more, or everyone could go through the questions?
Samantha, there is a problem with the question 3. Answer are related to the TRL, but the question is related. Okay.
I know. I just see this. There was some technical.
No problem.
Sorry, this morning.
No problem.
Anyway, okay. So I am closing now. Okay. So first, you founded already your company and are about deploying your business with paying customers, right? Sorry. Yeah, your cash flow starts to become predictable. Which market readiness level did you reach? So indeed, you are between actually you are in the business testing. No, you are in the business deployment phase, which is basically between 6 and 9. So 8, 6, and 9 are actually correct. 5, no. 5, you are still in this business testing phase. Second question. You founded already your company and are currently testing your business by involving early adopters. This is correct. Although you can also use MRL4 because you work also already there with stakeholders. Yeah, but 5 is the correct answer. And I apologize for the third question. Something happened there. So I would not go for it. But indeed, if you are currently testing your business at the technological level, yeah, we are talking about demonstrations. So you are actually either TRL 5, 6, yeah. So, and you want to create your business and have developed an innovative business ID. So first steps to reach a proof of concept have been reached. Indeed, we are talking about a TRL from 3, not from 2. It's 3. Okay. So let's go further. Okay. The next, the next question, oh, I see there is a, yeah, I see, Anthony, I see there is a problem with question 3, okay. So the next question you have to answer is, how are you going to enter your target markets? This is where we are talking about your commercialization strategy. What is part of your commercialization strategy? So how are you going actually to define your define your marketing? And we are using here one tool. It's called the 4P or 7P marketing mix. So this is where you defined your product, your price, where you are going to place your product, and how you are going to promote your product. And for highly intangible products, so for example, when it comes, it's not a tangible product, but more a service, you can extend the 4P marketing mix to 7P marketing mix, where you analyze also the process, the people, and the physical evidence of your innovation. Yeah. Let's go now through the detail of this marketing mix. So basically, let's start with the 4P. So the 4P is price, product, place, promotion. So about the price, of course, you have to set up the price. How much are you going to sell your product? Yeah. How do you want to differentiate also your product from the competition? Yeah, regarding the price. Which price conditions are you considering? And it's all about all the aspects around discounts and allowances, yeah, as part of your business model, how you want also to connect with your customers. This is all the parts which is related to the price, which will have a direct influence on your income, yeah. Then on the product, yeah, set up your product line, yeah, set up your quality level, and of course, which warranties do you have to guarantee the quality of your product? Yeah. The place, your distribution channel. How are you going to bring this product to the market? Yeah. Which distribution channel are you going to use? Yeah. Are you going to work with distributors? Are you going to work with the network of boutique? Yeah. So are you going to start at a local level, national, or going directly international? Do you go for a direct or non-direct distribution, etc.? So this is all about the place, all your channels, how you get your product to the customers, to the end users. And of course, how do you promote? Yeah. So have a very strong communication plan. Yeah. What about your advertisement? Are you going to go on TV? Are you going to use more newspapers? Are you going to use the internet, etc.? Or you go more, you sales directly. Yeah, some startups, they have their own online shop, and they are selling their product directly to the end users without going through distribution network. It can work, but then when it comes to grow, it's quite difficult. And for a product or for innovation, like more on the service level, this is where you are going to need to define in your marketing plan also aspect related to process, people, and physical evidence. So on the process is that how can you assess your performance also? Yeah. For example, we are talking here about a digital product, yeah, which is promoted on the internet through the social media. There you will consider, okay, by counting the likes, counting how many people went to the website to check your product, etc. You have to establish very clear work steps, how you are going through how you are going to assess your performance process. Yeah, this is the part also where you actively integrate your customer, where you strengthen your relationship to customers. People is the most important asset of your company. You can have the best product, you can have the best promotion campaign, the best marketing, yeah, you can have as much money as you want. If you don't have great people or the right people for your business, you have nothing. That's why this is the assets that you have to consider as the most important, and you have to share them. Yeah. So it's about motivating your people. Yeah. Educating them, providing them any training opportunities, etc. We are talking, of course, here at more at the level of an established company, yeah, because startups, most of them, the founders, they are motivated, and so this is more aspects that are in consideration when you are bigger, getting bigger and established. And then some physical evidence. So if it comes, so for example, getting some facility design, or if you need for your product some certificates, yeah. For a highly industrial product, you need the European certificate, yeah, that it's certified at European level to be able to sell your product, yeah. So all those aspects are very important when it comes to develop your commercialization strategy. So this is actually the work that you have to do when you are at a TRL or MRL from 8 to 9, between 8 and 9. This is exactly where you should put the focus on your marketing. Yeah, prepare your commercialization. So couple of questions that you can ask yourself. Has the focus of the market entry strategy been defined? What do I want to reach, yeah, with my marketing, yeah? What is my vision? So have product, price, sales, channels, and communication been coordinated, yeah? Does the price rely on the standard price of this type of market, yeah? Are the sales channels the right one, etc.? Which or what price are charged by the competition? What price will be charged for the product? What after-sales services could you offer? Yeah. So what happened when your customers has bought your product? Yeah. Do you offer any kind of after-sales services to be able to provide some consulting, some help, any kind, or a hotline, whatever? How high is the profit margin? What volumes are envisaged for sales and turnover? Of course, you have to consider, okay, how much I'm going to sell the first year, because you have to guarantee that that you are able to produce it. Yeah. And of course, it's also directly related to cost, to direct cost. Have the sales channels and the sales organization be named? Yeah. Also, do you have any commitment with those sales channels or organization? Yeah, that you have to guarantee that they are going to sell your product. How are your sales organized? Are qualified sales personnel available? So do you have a sales team? Do you need a sales team? Who's going to manage the sales? And of course, how much does the marketing is going to cost? This is a huge amount. Marketing costs a lot of money. And which advertising materials will be used for which target groups? Yeah. So use those list of questions as a checklist when you are preparing your marketing mix, your commercialization strategy, to be sure, okay, that you have everything under control. So how can you explain also, how can you explain that your product is going to evolve? So like I said, products evolve over time. The characteristic of an early stage product are of course different from those of a mature one. And we can represent this along a so-called S-curve, yeah, showing the different phase of development of the maturity of the product. So when you reach actually the mature phase, yeah, after having developed everything, you have to consider that your product is actually in that phase you will experience little growth. So you have to think about it. Okay, what I'm doing next? Should I consider new markets? But for that, should I diversify my product? Yeah. Or do I want to add some new functionalities or new components to the product? Yeah, to reach a new target segment, market segment, so new customers. Yeah. And this is actually where also you start asking yourself, okay, how am I going to scale up my business? Yeah. So how am I going to keep my growth further? So this is where you start, you know, first you develop a first product, and then you think about developing a second product and eventually a third product in keeping with the objectives of increasing your widening your target markets and customer target customers. So basically, when it comes to expanding product lines, it's also about, you have to think about how you can diversify your business. Yeah. Some businesses, they decide that they completely change the market, or they provide they have a huge portfolio, and then they can really address different target markets. But this is actually the case of the large companies. Startups or small companies, they usually don't have the resources to address at the same time different targets. So in that case, I would say it's maybe better just to diversify the product, trying to reach more customers in the dedicated market, or to provide additional values to the customers that you have. And then you can be, in that case, you could increase, you could change slightly your business model, and to see how you can generate more income with the same customers, providing new functionalities, new components, but increasing the values of your product. To make an example, one of the Nespresso machine, yeah, the Nespresso machine actually did exist before it came to the market, before the publicity with a very sexy American actor, which I will not name because I forgot his name now. But actually, Nespresso was providing industrial coffee machine for companies. They were actually more active in the B2B business. And they realized that they were not growing anymore. They reach exactly actually this mature phase. So what did they say? Okay, we have to diversify slightly the products. We stay in the same area, in the same markets, but we will diversify the product, providing a product for the community. So they step up into a B2C market. And what they did, they changed slightly actually the design of the machine. They changed the caps. So you can see the caps for industrial machine for companies, they are actually flat and round, while the other one, you know, them are actually has a like of a trapezist form. And they just revolutionized the market, the coffee market, the coffee taps market. Yeah. So this is an example to show you how you can diversify slightly your product. Yeah. By extending your customer base. Yeah. And your market segments, but staying in the same area. Of course, what is very important is you need a product roadmap. Yeah, so you need to have your topics. You need to have your time frames of release. Yeah, which features of the product are going to be built and when are you going to release them. Yeah, I was talking now about you have a first version of product, and after, I don't know, a certain amount of time, you decided to diversify slightly your product and you provide new functionalities or new components, etc. You need to have a timelines and a clear plan how you are going to proceed. And also to consider which problems you might face on the road to success, on the road to growth. Yeah, and this should be put into your so-called product roadmap. So this is very important for an investor because he sees a certain continuity, yeah, and sustainability of your product. So basically, question to us: what are you going to do next? Yeah, when you started, when your product is on the market, what are you going to do next? What are your product's future capabilities? What problems are you going to solve? Are you going to solve new problem? Yeah, if you want to target new customers, they have other problems, so you need to analyze those problems. What features will be available in the next release? Yeah. The next step is traction. I said before, traction, a lot of investors, particularly in Europe, not in the US, but particularly in Europe, European investors are quite, well, are very conservative. And they want to see that you have already reached some market traction to be sure that your product has a market potential. So market traction is about providing quantitative evidence of the market demand. So you have to show that you have customers who are interested in your product. Yeah, and this the market traction shows also the investors that so your product has a market potential. This decrease the level of risk. The more market traction you can demonstrate, the less risk there is in the investment, right? So, but you will ask me, yes, but for a startup who's still in this development phase, yeah, and they did not commercialize their product yet, how can they show some market traction? Well, in that case, it's always good that you have so-called pilot customers. For example, if you are in this demonstration phase, TRL 6 until 8, or even MRL 6 until 8, you have early adopters, you have pilot customers, you have stakeholders you're working. So it's always very important that even you are still in the development phase, you should already start to acquire some potential customers. Yeah, even if they are not paying for your products yet. Yeah, but you could ask them, okay, would you agree to test my product in your production line? And for the next 6 months, you don't have to do anything, just to deliver some analysis data to see for the validation process of the product. Yeah. There are ways to generate market traction even if your product is not on the market yet. Yeah. So you can also conduct some primary research like surveys, also discussing with potential customers. Yeah, making a kind of a small market study. Yeah, getting in touch with people who might be interested to buy your product. When you are raising seed capital from angel investors, you will need to take your market traction to the next level. This includes, for example, getting some beta testers. So you have some end users who would agree to test your product. So you have a validated prototype. Yeah. Well, the product is well developed. It's maybe the design is not finished yet. It's just about to get to the market, and you propose to some potential end user just to test it. Yeah. You could also try to have some first paying customers. Yeah. Who are ready to test the product. They have they pay a lower price, being a beta tester. Yeah. But this would also allow you to have to get a traction for your business angel. Yeah. Lastly, well, later when you are raising Series A capital, so this is when you are raising a bigger amount of money. So there we are working with venture capitalists or institutional investors. You need to show how you are going to scale your business. And this is where the scalability component is very important, because you are in this expansion phase, in this growth phase. So it's showing how are you going to upscale your business, your product, and showing how sustainable your business model is. Yeah. So this is the part which is actually more important for your for this type of investors. Okay, it's also very important that you know how you are going, how your exit is going to look like. What is an exit? Basically, it's when the company gets the break even. So they make themselves financially independent. There are different exit strategy. I'm going through all of them. I will not go into the details of each of them because it's a complex point, but it's just that to provide you an overview of the different exit strategies that can be considered. So you heard several times the IPO, initial public offering. So it's when you go public. So you are actually selling your shares to institutional investors. So you enter the stock exchange market. Yeah. You can also, the management, so the trade sale, so the management of the company decide actually to withdraw, and they sell the company to another company, the same branch. This is something which is very common in the US, the so-called serial entrepreneurs. They are people, they are just talents to build ventures, to develop them, to making them growing, and then they sell it and they start the next business. So this is exactly when we are talking about trade sale, this is exactly the scenario of a serial entrepreneurs, someone who's only interested in establishing businesses, building them, and then when they grow, they just sold it. And in some cases, those entrepreneurs, they become themselves also business angels, investing also in other ventures, in smaller ventures, and providing also their expertise. There is also the secondary sale. It's, for example, this is when you sell your company to another company, but which is actually in another branch, and they want to diversify their market, so they decided to buy this company. This is this is generally done also through big private equity or hedge funds who are actually buying companies to integrate them into their portfolio and making them further growing. Company buyback. This is, for example, when the founders, they just buy their shares back. So they are buying all the shares back from the investors, and they keep running the business without any investors. This case is, of course, very nice, but it's quite rare. It's quite rare because most of them they prefer to go public, keeping on leading the business, but merging an acquisition. This is when you are merging with similar company or being bought by a larger company. So you have heard, you know, the bigger players, Google, they bought lots of startups, etc. So this is exactly where. This is also a part where some serial entrepreneurs, they did like this. They just sold to Google and then they start a new business. Yeah. Or you make it your cash cow. Business is running, you have a good revenue stream, you pay off your investors, and then you find someone you trust running your business, and you just get actually you just get the ownership annuity, and you can become a privatier. Yeah, so you can rely on getting your money regularly, and your business, you don't look after your business anymore because someone professional is doing it. In other case, we are talking about reimbursing the mezzanine capital. So the mezzanine capital, this is a form of financing when you are actually partly financing your company with equity and debt. It's a kind of hybrid capital. So actually you take a kind of loans. So a part of, if for example you need let's say you need 1 million euros, yeah, and you said, okay, I will take from this 1 million euro, I take a loan or a debt for 250,000 euros, yeah, with X percent of interest. And the rest, the 750,000, I'm going to share some shares, some equity shares of the companies. So that's where you are actually mixing, it's a hybrid financing, because you are mixing actually debt financing and equity. So so in that case, you could pay back this capital. So you are actually paying back the debts that you have and taking back the shares that you have sold at the beginning. And the last is liquidations, is when you are actually, this is of course the worst situation you can reach. The worst exit strategy is basically when you run when the business is not solvent anymore, and you are liquidating the business. So the assets and property are being redistributed to others. The founders team. I said before, the most important and most valuable asset of your company is your team, are your people. But it's also the founder team. The founders team is very, very important. Investors, before they decide to invest, independently of the product, of the market, they look at the team. Yeah. If they are not trusting the team, they will not invest. As good as the product is, as high as the market potential is, they will not invest. Yeah. So they have to be convinced by the team. So, and they have to get the feeling that the founders team is aligned to each other, that they have the same vision, they understand the same goals. Yeah. And they also contribute to each other with their competencies. So an ideal team is a team of people looking at areas in the company in relation to their strengths. Yeah. So I think maybe everyone needs a coffee break now. Everyone back?
Yes, I hope.
Yes. Hello.
Okay, great. So let's continue. Okay, the next step is about the financial plan. This is, of course, very important for an investor. Yeah. So what do you have to provide? Basically, any investors wants to have a balance sheet, a profit and loss account, and have a cash flow, a kind of cash flow report. Yeah. For startup, the cash flow is the key item for the management to check solvency and identify when out of cash is looming. Yeah. So take care also of your burn rate. Yeah. Your burn rate is actually used to is the rate that at which a new company is spending its capital. And the investors are looking at this. Yeah. So how quickly a business is spending his money. Yeah. And they use this metric actually to measure how long a company will become profitable or need new funding. So let's go through the different financial statements. Of course, well, I did not put any balance sheet because I suppose you know how a balance sheet look like. Yeah? But what is very important is the profit and loss statement and your cash flow. So I put here together basically this is this is your financial plan that you present to the investors. Yeah, you can do it on a monthly basis for the first year, on a quarterly basis for the second year, and on a yearly basis for the third year. So it's all about your revenues, all your costs. You have to show your operating income. Yeah. So what are your actually your revenues when you have paid all your costs, and also where you establish your EBITDA, which is your profit before income taxes. Yeah. And when you take off the taxes, what is your net profit? Yeah. So your cash flow is basically the money it's your liquidity. Yeah. It's the money which stays when you have spent or when you have paid all your costs. Yeah. By adding the cash flows of different of several years, we call it the cumulative cash flow, and this represents actually the funding gaps that you will be requiring for what you will be requiring capital from external funding. I said before that you have to be very careful about your burn rate. Yeah. There are two burn rates that are being considered. The first one is the gross burn rate. This is actually regarding the company operating expenses. Yeah. So how quickly they are spending money for their operating expenses. Yeah. So you sum all the operating expenses like rent, salaries, or any kind of overheads. Yeah. On a monthly basis. And then you divide your amount of cash through your monthly operating expense, and then you have your gross burn rate. So it says you how much percent you spend from your cash for your expending expenses. Then you have the net burn rate, which is basically your loss. So measures the gross burn rate is actually how much you spend for your operating costs. Yeah. And the net burn rate is how quickly you spend your money. Yeah. So it's basically dividing your cash through your monthly operating losses. This is, like I said, it's to give the investors then an idea how quickly he will probably have to provide you with additional funding and how long you are going to hold with one funding round. I will not go too much into the detail here, but it's just to give you an overview about the business metrics that you have to considerate in your financial plan, and which has to be very strictly calculated and planned in order to convince your investors to invest in your company. So now we are going to the third step, which is about the valuation. I'm tackling this topic very superficially here because, like I said at the beginning, about valuation, you can make a own training. Yeah. So I'm just presenting you the different what is about valuation and some methods of calculating the valuation. So basically, you have to determine the current or projected worth of an asset of your company. How much does your company value? Yeah. So there are two types of valuation methods. You can evaluate your valuation on an absolute basis, yeah, or on a relative basis. So I'm going just to show you that when I'm talking about absolute valuation, it's about evaluating a true value. Yeah, so the investors is looking at your dividends, at your cash flow, at your growth rate, and they are not comparing it to other companies. Some other investors, they prefer to they compare actually to evaluate your company. They make they make a benchmark with other companies from the same area. So actually, they are evaluating the business on following relative models involving complex calculating multiples and ratios, like the price to earning multiples, which is basically how much one share is valued. Yeah. So if you sell one share of the company, how much cost one share? So they are evaluating those ratio, comparing them with other companies, and this is actually quite yeah, it's not I cannot say it's not a realistic valuation. It's another one. Both methods are validated and can provide different values. Yeah, so it's always the investor decides which methods they want to use for it. I'm just showing you very quickly the different methods and techniques for valuation. So you have the so-called DSF analysis method. So actually calculating today's value of expected future cash flows. Yeah. So they are performing a kind of cash flow analysis. Yeah. How your cash flow is going to evolve in the next years. They are analyzing the different multiples. Yeah. So they estimate the value of a company using the multiple of comparable companies. So this is this benchmark. Yeah. Then the net book value method, so calculate the net book value of tangible and intangible assets. So they are actually evaluating the value of all your, with your equipment, your assets, your patents, etc. Then there is the scorecard valuation methods, which is using average valuations of startups operating within the same sectors. This is so it's also a kind of benchmark methods. Venture capitalists, they concentrate more on post-revenue valuation. So they use actually this figure to evaluate a pre-revenue valuation. So it calculates on what you have already achieved in the past, because normally when you go to a venture capital, you have already raised funds with other investors. So they rely on your past valuation to forecast a pre-revenue valuation. Then you have the Berkus methods. This is you calculate the value by assigning a value of up to $500,000, well, dollars or euros, whatever, to different parameters. And then you have the risk factor summation method. So you estimate the value of pre-revenue startups by scoring 12 risk categories. I'm not going to the details because this is very complex, and I'm not sure that you really It's very, it makes sense to present this everything in detail today, but you just have to be aware that investors are using different methods for the valuation. Okay, now of course it's very important that that you handle with the right investors. I'm going just to present you the investors shortly. So I told about the business angels. Business angels are actually perfect for early stage funding. Yeah. So if you are seeking for funding between 20,000 up to 250,000 euros, actually it's a business angel is the right investors. What is very interesting is that an investor, business angel, when he invests in your business, he's not looking, of course, he's looking at the return on investment, but not only. He has to be convinced by your product, yeah. And most of the time, they are very active also in the management of the venture. They are also providing expertise, coaching, so working with the founders, helping them to grow their businesses. Yeah, they are different type of business angels. I just sum up all of them here. We call them the entrepreneurs angels. So those are people who are all their life long working in management, and they are actually mainly expecting return on investment from companies they invest in. So getting actually majority stakes, etc. You have the income seeking angels. Those are in general engaged in investors networks. So for example, the business angel networks, members of the European Business Angels Network, and they invest for income or to gain a job. So actually this is their job. They are business angels. Some business angels, they are doing another job parallelly, but those ones, they are really working. This is their main job. Then you have the wealth maximizing angels. Those are wealthy investors who invest high capital without interest of active influence. So they just leave the venture working. They provide some expertise, some advice, some coaching, but they are not actually dealing with the management of the venture. Yeah, they just want to get their money. They just want to invest their money, and it's like, yeah, they have so much money that basically they don't know what to do with it, so they just invest it. Then you have the corporate angels. So those are active entrepreneurs who want to strengthen their own corporate, for example, through the investment. So they want to extend their portfolio. Then you have the latent angels. So those are investment experience investors but who were not engaged in the last 3 years in any kind of investment. And then you have the virgin angels. Those are the very new one who are just starting with this new experience. What is interesting by business angels is that actually most of the time they invest in the company because they believe in the product, and also because they want, it's a kind of award, you know, to have a certain company in their portfolio. So it's about showing themselves, showing their portfolio, and it's less about the return on investment. Banks provide mostly credit lines and loans for working capital. Yeah, they provide also so-called subordinate loans, which are a kind of quasi-equity, and which also allows company to increase their rating. Yeah. And increase also the valuation that way. What is interesting is that banks, you know, they are quite good linked with leasing and guarantees and equity companies. So they have a huge network with microfinance institution, crowdfunding, etc., which actually can give you a good overview also of the regional financing ecosystem. But banks are not so good for SMEs, yeah, because they have quite high interest rates. They have insufficient collaterals. Yeah, they want, well, if you have less warranties and collaterals, they normally they are not happy. It's too much paperwork. So actually, to start a business, it's not the best investors. Although I have to say, you have the so-called regional banks, like well, in Germany we have the L Bank, those or the KfW. Those banks are actually getting also financing from the European Investment Bank to support startups in their region. So those banks have, of course, other programs, and some of them have also dedicated funding programs for startups. But I'm talking here about banks in general, not those regional banks in particular. Then you have the crowdfunding. So I said this is mostly through platforms. So actually, it's a group of small investors who want to invest in company. There are three forms. So in crowdfunding, you have two different forms of funding: either loans, so people are actually lending money and they get interest, or the crowd investing, so they are investing in company and getting shares then for their money. There are three forms of crowdfunding. The first one is the so-called rewards donation. This is, for example, in small investors, they are just donating the money because they believe in the cause. For example, if a startup is developing a new product to fight cancer, and those investors believe in that, they are ready to donate it. Yeah, so this is actually this rewards-based crowdfunding where they get so donation. Then you have the peer-to-peer lending. So this is basically investors lending money for interest rates and getting interest rates on that money. And you have the equity crowdfunding, which is based, they lend money and for that they get equity shares. This type of equity investment, it can go up to 200,000 euros. So it's not, so this kind of financing, crowdfunding is, it's for a small amount of money, yeah? So less than 500,000. You will not get millions here, yeah? Next is venture capital and corporate venturing. So venture capital, so it's a form of private equity. Those investors provide to startups, company, and small businesses who with a long-term growth potential. Yeah, and corporate venturing are the so-called corporate venture capital. So ventures from big companies who invest in business that are interesting for their own business. Yeah, and for their own portfolio. For example, Bosch. If I'm taking the German examples, Bosch is investing, Bosch Ventures, Daimler, I mean, there are many companies, or Johnson & Johnson, all those big players, they have ventures department investing themselves in companies. The difference between business angels and venture capital is actually on different level. Business angel invest their own money, while venture capitalists, they invest actually other people's money. So they are managing funds. Yeah. Business angels have no one to justify investment decision. Yeah. Venture capitalists, they have investment committees. So before they invest in a company, they have to check internally with the board, with the investment committees, with the auditors that are working for the venture capital fund, if this investment is worthwhile, while the business angel decide himself if he's investing or not. Business angel can accept greater identified risk. Venture capitalists, generally, they need to mitigate the identified risk. Yeah. Business angel, they don't need to make investments. venture capital, yes, this is their job. They are paid to make investment. Their business is making investment, making money. Business angel can also provide specialist skills, so experience, and venture capitalists, it's more on the commercial level, so they help the companies more, you know, on all those aspects with the commercialization and the market, etc. And business angels provide less capital, while venture capital have deeper pockets. So, small question again, and it's no, sorry. I would like to ask you to identify which source of finance you would consider if you are first seeking for seed finance in order to develop your first prototype or product. Which finance you would consider if you are seeking for financing in your expansion phase. I'll let you 2 minutes for those two questions. Sorry. Okay, so which source of finance should you consider if you are seeking for seed finance in order to develop your first prototype or product? Yes, business angels, correct. Public funding is also correct. Venture capital, not, because you are not generating any market income. So venture capitalists will not invest in yourself. Which source of finance should you consider if you are seeking for financing in your expansion phase? Private equity, correct. Corporate venturing, correct. Venture capital, correct. Bank loans, correct. Own resources through retained profits, it's correct. Okay. So we are coming to the end. So how do you manage dynamics in negotiation and achieve best results? So basically you have to be aware that raising an investment is long. It lasts 6 to 12 months. Yeah. VCs and corporate VCs are quite spoiled children. Yeah, they always say no. If you go too early, if you are too early, you get a no. So VCs and CVCs VCs, they are quite difficult because, of course, they are not investing their own money, so they have to be careful. Also, investing in the right companies, and they, like I said, they got so many pitch decks and business plan that you really, it's quite tough. So you have to keep on track on it. And what is very important is that before you get to an investor or a VC fund, yeah, you should make a small analysis, yeah. So which sector is this VC or investors active? Yeah, is it your sector? What other companies do they have in their portfolio? Yeah, is there a conflict or an alignment with another company? Because if you see that they invested already in a competitor of you, you have no chance. Are there a leading player in this sector? Or do they syndicate as part of a wider group? Yeah. Or are they currently investing? Do they have any available funds? Yeah, because it's possible that they are just closing a fund, yeah, and managing the preparing the next fund. So in that time they will not be investing. So this is important that you make some research at the beginning to analyze this type. To see where if the investor is ready to invest or not. Sorry, yeah. What are the costs of raising your investment? Yeah, so the thing is that looking yourself for an investor takes a lot of time. And actually, if you are busy with your business, you don't have this time. So some of you might consider to charge an outside consultant or an investment banker or someone who can look for investors for yourself. So this costs some money. Then to prepare your pitch also, if you have to pitch somewhere, you might have some expenses for that. If you have to produce a video or to be present online. Any kind, for example, if you have a consultant, you will have to pay some success fee, yeah? So those are any kind of cost also that you have to consider when you are raising investment. Legal fees as well, because you need a lawyer who are helping you to set up all the contracts. So take your time, yeah? Like I said, it takes it's long, but you need the time and takes your time. So the first 2 months, you should plan your investment raising strategy. Yeah. So the first two months, you are talking to many individuals and groups as possible. Then you find a lead that can speed up the process and they will help from the round. The next 4 months or more is hopefully all about the due diligence. So if things are going well, you might have a first time term sheet after 6 months. Yeah, but normally it takes longer. So next step is your due diligence. So of course, an investor, before he starts investing in you, he will take he will deep dive into the financial of the company. Yeah. So you will have to provide some regular management account reporting, the director and staff contracts, sales process and contracts, any documents about the IP strategy. So it's actually helpful if you can set up all those documents before, you know, and that you have them ready before starting your fundraising campaign. And of course, craft your pitch deck. Yeah. So now we are going quickly to the pitch deck. I'm just giving you some advice how you can craft your pitch deck. So you need to convince the viewer of why the market opportunity is large. Yeah. So make your market research provide tangible and realistic figures. Do include visually interesting graphics and images. Do tell a compelling, memorable, and interesting story that shows your passion for the business. Do show that you have more than just an idea and that you have got early traction on developing the product, getting customers and signing up partners. Do have a soundbite for investors to remember you by, yeah. So, the typical don'ts to avoid in a pitch deck. Don't make a pitch deck more than 15, 20 slides. Actually, 15 slides is already too much. I always said to my startups, 10 slides maximum, not more, yeah? So don't put too many words in your slides, yeah? Don't provide excessive financial details, because if they need more details, they can get them in the follow-up exchange. Don't try to cover everything in the pitch deck. Yeah, your pitch deck is just like a kind of nutshell of your business idea. Don't use a lot of jargon or acronyms that the investor may not immediately understand, which are typical related to your technological or scientific domain, because if the investor doesn't understand you, he will not listen to you. Don't underestimate or belittle the competition. So it's very important that you know your market, you know your competition, yeah? And the investors needs to be convinced that you know in which environment you are acting. Don't have your pitch deck look out of date. So don't put any date. So have always an actual updated pitch deck, yeah? This is the worst you can have is when your pitch deck is not updated. And put an effort on delivering a good layout with good graphic and how quality. It should be visually nice to look and to feel, yeah? So maybe you can think about hiring a graphic designer to give your pitch deck a more professional look. Which key slides should be well, at least key elements should be in your pitch deck. So you need a company overview. What about your mission? The team? Which problem do you solve? How do you solve this problem? What is your solution? What is the market opportunity? You describe your product, of course, your customers. Who are your customers? What are their needs? Yeah. You present the technology, the competition, your traction, your business model, how are you going to make money, your marketing plan, your financials, and how much money you need. You see, I said 10 slides. You can put elements together in one slide. I mean, problem and solution and product can be put in one slide, for example. So for me, 10 slides is actually a good standards pitch deck, and it's not too long, and you can provide enough information in 10 slides. So just now, this is my last, my last slides for the training today. I just wanted to provide you some do's and don'ts when you are dealing with investors. So don't wait until you really need the money, yeah? Don't wait that your bank account or that your liquidity reserve are empty to start to fundraise. Start early enough, yeah, because you should not give a desperate feeling to the investors that you need the money. This is not good. Yeah. Think ahead and plan to fundraise well in advance. So what I said. Take advice from people who have done this before. Yeah? Work out exactly how much and what sort of funding you will require. Yeah, it's very important that you have a clear figure in your mind, how much you need and how much you are ready to give for this money and what you want to do with this money. Plan whom it is appropriate to approach. So like I said, make your investor research, mapping. Provide them with the information they are looking for in the format they want. Communicate effectively and honestly. Don't lie to them, because at the end, they get all the financial papers. They will see exactly what's not going on. So be honest. Summarize the objectives of the business to communicate them succinctly and with impact and conviction. Ensure the company's objective that they have a commercial focus. And last but not least, and this is very important, you don't sell your product to the investors, you sell your business. So I would like just to have a last poll with you, and it's just to have, this is for me, this is actually for me, to have a first insight. What was the most valuable thing that you have learned during this training today? So I let you 1 minute to answer this question, and then we are finished with the training today. Okay, so I see that the most valuable was for you how to deal with investors and a better overview of all sorts of financing. And the other one, okay. So I like to finish always with a nice proverb and I used to take a word from Warren Buffett, which is one of the most famous investors in the US. The best investment you can make is in yourself. Thank you very much.